Sawadee Cup, Tutani. Hello everyone, welcome to Global Talk. I'm Graeme Cunningham, Global Investment Strategist at Asia Plus Securities. Today we've got four things to talk about. One, we're going to talk about the Fed meeting this week. Second, we're going to talk about US GDP quarterly growth that was reported. We're going to talk a little bit about oil prices, the recent slide in oil prices, and we're going to talk about US tech results, which also came out this week. So we had the Fed meeting last night. Janet Yellen did not increase interest rates, but it was guided that likely we're going to see an interest rate increase in June this year. The odds of that hike have now increased to 94%, so the market thinks it's pretty much guaranteed that there is going to be a hike. If we can go to the first slide, I'm going to show you again. We've talked about this before on Global Talk, but I'm just going to review the math behind why this matters. Basic valuation math is shown in my first example here. If you take any asset, let's say it has 100 units of cash flow, and then you divide it by a discount rate of whatever percentage to get your asset value. So in this case, I've got 100 units of cash flow, so that's assuming that that instrument generates that cash flow going out into perpetuity or forever. Every year, that's what the cash flow will be into the future, and that there's a discount rate of 5%. So we could assume that that discount rate is, let's say the Fed rate is 1%, so the base rate, and then there's a premium for the risk of equity. So roughly in terms of risk to an instrument, you've got cash, which has effectively zero risk, government bonds, which are also considered a risk-free instrument, and then you've got corporate bonds, a little bit more risky, and then you've got equity, even more risky. So that's the risk premium. So if you take that 100 in cash flow, divide it by the 5% discount rate, you get a value for the asset of about 2,000 units. So what happens if we see an increase in that Fed base rate from 1% to 2% while the risk premium stays the same at 4%? We can see that in the second example. We've got 100 in cash flows still. Base rate goes up to 2%, risk premium is 4%, the discount rate is 6, 2 plus 4. And then we get a value for the asset doing that simple math, which you can do yourself using a calculator or an Excel spreadsheet. You can see that the value is now 1,667. So a 16% drop just from that increase in the interest rate. Now this is just to give you, these aren't the real numbers that are out there, but it does give you an example of why that increase in the discount rate matters. Now, one thing to consider is, why do the cash flows on the top, why does that 100 stay the same? Shouldn't that grow? Now in this example I've kept that the same, 100 for both examples. But you could say that one of the reasons that the Fed is increasing the discount rate is because the economy is improving and cash flows and earnings of corporates are also improving, GDP is improving. So maybe on the top that should move from 100 to 120 or 100 to 140, and then that would offset, if you do the math, the increase in the discount rate. And that is a viable concern. I wanted to control just for that rise in the interest in the discount rate, but you could say that there is a reason for that and there's an offsetting factor. To that end, we can move to the next slide, which is quarterly real GDP growth. How are things growing in the major developed economies right now? Is there a move? Is there a reason that we can justify some increase in that cash flow from 100 to not 100 to 100, but 100 to 120, or 100 to 140, or whatever increase would be reasonable? Well, the U.S. In its most recently reported quarter, real GDP growth was less than 1%, just 0.7%, which is not really very strong. and also doesn't really support the idea that corporate earnings growth would be stimulated by such a low growth rate. Now, there's a few things we have to consider. That, as you can see, if you look at the blue line in this chart, you can see that, first of all, that series is very volatile. So just because we have 1 quarter of low growth doesn't mean that will continue. On average, people are looking for a couple of % growth in the US. So we may see a rebound. Interestingly, if you look at, I've put 3 black lines on this chart. The first one is -1%, and the second is 2%. And you'll notice that the economies of Europe and Japan, which is the green line and the gray line, they really don't move much outside of -1% growth to 2% growth since 2009. So over the last 7 odd years, you've really seen them have a pretty slow growth, on average somewhere around 1% or less. Now, if you look at my third line, the black line, that's at 3.5%, and you'll notice that the U.S., which is the thick blue line, does rises above 2%, goes near to 4% or above on several occasions. So you can see the U.S. is really a very important driver of the developed, in terms of developed economies. In my chart, I haven't included China. That's a developing economy, not a developed economy, and kind of has a stronger growth profile, and is something to look at for another day. But in terms of developed economies, the U.S. was a major growth driver, and it's just its size. It's still the largest economy in the world, so it's really important for developed market growth. So when we see numbers like 0.7%, especially with all the talk of the economy improving, and a lot of the money that's been printed and sent to the economy by the Fed over the last 6 years, this kind of growth is not really that impressive, even if we compare it to, especially compare it to the historical growth, where you're getting a lot of quarters where we're hitting the 2%, 3% range for the U.S. or above. So in recent history, not a great number, but again, we'll have to see. We've had dips like this before and then recoveries. So we really need to see, is this a trend or is this just 1 weak quarter? So we'll really know next quarter if this is something that is an issue or a problem going forward, or just an unsustainable slip, and then we pull back up to trend. So we'll have to see on that. Doesn't look great though. Next story is the oil price. Oil prices have really slipped over the last few months, which is interesting. Brent peaked out somewhere in December at around $55 US. You can see from my chart in the blue line that it's about $51 now, quite a drop. Around $50 peak in December for WTI oil, and now it's down to around $48. So pretty big slip for oil, which is interesting because in December we had OPEC, which is as a group, that's the Organization of Petroleum Exporting Countries, together decided to cut production. So if you have a cut in the supply while demand remains relatively the same, then you should have an increase in the oil price, but we've had a fall. It's given that OPEC is such a major producer, all the countries together is the largest producer of oil in the world. So what's actually going on there? If we go to the second chart, we can see what's happening. So we can see that, so OPEC in December, their oil production was 5% year on year. It's dropped as of March to -1.8%, so a big drop there. So most of the members have obviously followed with the cuts that have been planned. The interesting part is that the increase in non-OPEC production, so that's gone from around 0% in December to 1.8%. So you're having in countries, especially like the U.S., increasing production, and other major non-OPEC countries increasing production. So that is driving that decline to some degree. The other issue is, on the next slide, the other two issues. One is that inventories are relatively high. So if you see the blue line there, that's inventories. It's like any business. If you have a high level of inventory, you want to sell that off because it's just stock that's sitting there. And so one way to do that is to reduce the price to sell off the stock. So that can be a driver. When you have high inventories, you want to get rid of them, so you lower the price a bit to sell them off. The other issue is global rig count. Now you can see the green line. There's been a big drop since 2014 in the global rig count to a trough in around the middle of 2016. Rig count was just continuously falling. Now that rig count is, the rigs are the oil platforms that go out and get the oil out of the ground or out of the ocean in terms of offshore drilling, and that has been increasing. So since the middle of 2016, which means more supply. So from 2014 to 2016, the lowering, the declining rig count suggests that you have less and less supply. If that starts to pick up, you've got more rigs out there getting oil. You've also got an assumed increase in supply. So again, if your supply is going up while your demand is staying the same, price will likely come down. So right now, these things have sort of in balance right now. So we need to see how things are going to look going forward for the next couple of months to see what the effect on the oil price will be. Somewhat hard to predict right now. We can assume that OPEC will continue to keep its production low. Really, it's whether non-OPEC production keeps increasing, whether this rig count. Now, the rig count increase has sort of flattened out between March and April, so maybe that's flattening out. Inventories were being drawn down. That has also flattened out over the last couple of months. So we have to see. We're kind of at an inflection point where it's hard to see which way it's going to go. So the final topic for today, U.S. tech results. It's kind of a mix. The weakest was certainly Apple. Made a minor beat of earnings. EPS growth was just 2.4% year on year, pretty low. Google was reasonably strong. The beat was only 5%, so they didn't beat by that much. Roughly met analyst estimates, but the growth was very strong year on year. Microsoft had a major beat compared to what analysts were looking for. Growth was low single digit, so pretty decent. Amazon had a big beat and big growth year on year, and Facebook had a reasonable beat of 20% and huge growth year on year. Although for Facebook, they guided for the rest of the year that they expected that they wouldn't be able to repeat this kind of level of growth going forward, so the stock actually came down a bit. Most of the you didn't see a major increase in any of these stocks. Usually slightly down on the day, although the results were strong. One thing is that maybe the U.S. market overall in tech, maybe people are thinking it's somewhat fairly valued. We don't think it's, the sector overall is massively expensive, but it's also not super cheap right now either. If we go to the next slide. One way to look at these, I've grouped these tech companies to make it sort of easier to understand the themes. The theme for Google and Facebook is that both of these have really become media companies. We call them tech, but really what it is almost 100% of the revenue of both of these companies is advertising driven. So in a way, they're like a television company or even radio or print. All of those things combined drive advertising revenue. And what you're seeing is this major shift from those old media, television, radio, and print, and you're seeing this long-term trend of all that revenue slowly going over to the internet, to the point where probably all of those things, television, radio, and print, will really all be the internet, and that shift is definitely already taking place. So these companies are increasing their market share of this massive, massive advertising market. That can go on for quite a long time. Advertising itself is actually quite cyclical, goes up and down quite a bit along with the moves in the economy, but that might not be such a problem for Google and Facebook, because they're increasing their share of this market, even if there's swings in its actual growth itself. That could offset, let's say, the advertising market itself is down 10%, but these guys have increased their share of it 10%. They can still see decent earnings. One interesting thing that Facebook was saying was similar to a television station. If a television station has sold all of its advertising spots, then there's not really that much in terms of upside to that company's earnings. They're all sold. Maybe they can increase the rates a bit, but Facebook is saying that they have the same thing, where a lot of their slots for advertising are actually full. So it's hard for them to grow because all of the space, the media space that's available for ads, is a lot of it's already taken. Now I want to look at Amazon and Microsoft. What's the common theme between those two? They seem quite different. One's a software company, one is an internet retailer. Actually, both of them are cloud-driven companies, so cloud services where you put all of your information rather than having it on your directly on your device, whether it's a phone or a hard drive or a computer. You have all your information stored on the cloud. That's becoming a major trend in tech. Both Amazon and Microsoft are big players in that area, and it's generating a lot of their revenue. And you think of something like Microsoft, they can keep all of your files and all of the software itself on the cloud rather than taking up space on your device. Amazon, although the revenue is all from the retail, like it sells books and appliances and all these other electronics, all these other products, the actual operating profit, although the revenue is mostly the sales of those products, the operating profit, the revenue of the cloud is low, but the margin is so high that the operating profit and the growth in operating profit is actually being driven by these cloud services. So it's interesting for both of these companies in terms of their growth, and where probably a bigger and bigger proportion of their operating profit is going to be from cloud services. So for Google and Facebook, advertising companies taking advantage of the shift from the old media to the new media. For Amazon and Microsoft, they really are tech companies, not media companies. They're based on the cloud. And then finally we have Apple in the middle, the phone company, as I would define it. And they're having issues now with innovation. If you really look at what has really been created, new big blockbuster products since Steve Jobs was managing the company, you really haven't seen anything. And there's some ideas for an Apple Car, and the Apple Watch has come out, but none of these have really been blockbuster products, and it's questionable how big the Apple Car could really be. So I think you have a problem in general with innovation, and Apple is building up this massive cash pile. I read yesterday that their cash only is the same size as the entire market cap of General Electric, which is one of the biggest industrial companies in the world. So quite interesting. They have all this cash. They don't really know, there's what they should be doing with it. So that becomes an issue for growth later on. You've seen in the most recent quarter, they've had a big issue with iPad sales collapsing double digit, and iPhone sales, which is over 50% of their business, is growing reasonably slow. So they need a new big product. We don't really see that coming very soon. So it's questionable what can happen for this phone company. So that is it for today. We looked at the Fed meeting, why a hike in June could have an effect on asset prices unless we see earnings growth come through to offset that increase in the discount rate. We talked about US GDP, not a great quarter, maybe that won't continue, maybe we'll see a rebound, but for right now, didn't look that great, while other developed economies, Europe and Japan, not growing very quickly. Oil prices, just generally supply is increasing more than people expected with demand the same, so the price is starting to come down a bit. Where we go from here is kind of an inflection point and unclear as to where that will end up over the next few months. And then U.S. tech results, which were overall pretty decent. Not much move in the share prices. They're maybe somewhat fairly valued currently. We'll have to see for the next few quarters. And then a definition of how to look at the different subsectors of tech. And that is all for today. So thank you very much. Please come and watch the show next week at 3:30 Thursday, like usual. I'm Graeme Cunningham, Global Investment Strategist for Asia Plus Securities, and this has been Global Talk. Sawadee Cup.